Ask most people where they want to build wealth, and they will tell you real estate, buy property, own something tangible, something you can see and touch and point to. It is the oldest piece of financial advice passed down through generations, and it feels so solid, so obvious, so undeniable that almost nobody stops to ask whether it is actually the best path. Warren Buffett has. The most successful investor in human history, a man worth over $130 billion who has spent 80 years studying every wealth building vehicle ever created, consistently and publicly chooses stocks over real estate. Not because he cannot afford property, not because he does not understand it, because when he runs the actual numbers, the comparison is not as close as the real estate industry wants you to believe. I am Maxine. I am Rich Auntie Knows. And today I am going to show you what Buffett actually says about stocks versus real estate. Not the soundbite version, but the reasoning underneath it. And then I am going to connect that reasoning directly to what it means for your money, your wealth building, and the decisions you are making right now. This is not an argument against real estate. This is an argument for understanding what you are choosing and what you are giving up when you make that choice. Secret number one: Buffett's real preference is not stocks, it is businesses. And that distinction changes everything. When Warren Buffett says he prefers stocks, he is not talking about trading. He is not talking about watching tickers or timing markets or picking winners. When Buffett buys stock, he is buying ownership in a business, a share of its earnings, its growth, its compounding return on capital. The stock is the vehicle. The business is what he is actually acquiring. And this is the first place the comparison between stocks and real estate becomes revealing. A property generates rent. A business generates earnings that can be reinvested, expanded, compounded, deployed into new opportunities, used to buy other businesses, and grown at a rate that a fixed piece of land simply cannot match. Buffett said in a 2018 shareholder letter that he would rather own a diversified group of American businesses than farmland. Not because farmland is bad, but because American businesses as a collective have compounded at rates that farmland has never matched over any extended period of time. A broad index of U.S. real estate returned roughly 1,900% over the same period. Both are real. Both build wealth. But they are not the same race. Buffett is not buying stocks. He is buying businesses, and businesses compound in ways that property cannot. Secret number two: real estate has hidden costs that the return numbers almost never include, and Buffett knows exactly what they are. The number people quote when they talk about real estate returns is almost always the wrong number. They quote appreciation. The property was worth $200,000. Now it is worth $350,000. That is a $150,000 gain. 75% return. Sounds extraordinary. It is not. Because that number does not account for the costs that property ownership carries every single year of the holding period. And those costs are substantial. Property taxes on a $350,000 property average between 0.5% and 2.5% of value annually, depending on location. On a $300,000 average value over the holding period, that is between $1,500 and $7,500 per year. Maintenance and repairs on a single family home average 1% of property value annually, another $3,000 a year. Insurance averages $1,500 to $3,000 a year. If the property has a mortgage, interest payments over a 30-year note on a $200,000 loan at 6% total, more than $231,000 in interest alone, meaning you paid $431,000 for a $200,000 property. If there are tenants, vacancy periods, management fees, and repair costs between tenants eat further into the return. If there is no tenant, the property generates no income and the costs continue. Strip all of that out of the $150,000 appreciation gain and the actual net return on real estate. Secret number three: liquidity is not a small thing. It is the difference between an asset and a trap. Buffett has talked about liquidity more than almost any other property of a good investment, and for good reason. An asset you cannot exit when you need to is not just less flexible, it is actively dangerous in the moments that matter most. Real estate is among the least liquid assets a person can own. If you need to access the capital locked inside a property because you lost your job, because a medical emergency hit, because a better opportunity appeared, because the neighborhood changed, because the market shifted in ways you did not anticipate, you cannot sell a bedroom. You cannot sell half the kitchen. You sell the entire asset on a timeline set by buyers and market conditions at a price that may or may not reflect what you need after paying a real estate agent 5% to 6% in commission, after closing costs, after capital gains tax on any appreciation. An S&P 500 index fund can be sold in seconds at market price, with proceeds hitting your account in 2 business days, with no agent commission, no closing costs, no negotiation. You can sell exactly as much as you need, $500, $5,000, $50,000, and leave the rest compounding. The fractional nature of stocks means you are never forced into an all or nothing exit. Buffett's preference for liquid investments is not about impatience, it is about optionality. Wealth that is locked inside an illiquid asset cannot respond to opportunity. It cannot protect you in a crisis. An illiquid asset in a crisis is not wealth. It is a wall. Stocks give you a door. Secret number 4. The leverage argument for real estate is real, and it is also the reason people lose everything. The strongest argument for real estate over stocks is leverage, and it deserves a direct, honest answer because it is a real advantage when it works and a real catastrophe when it does not. When you buy a $300,000 property with $60,000 down, a 20% down payment, and the property appreciates to $360,000, you have made $60,000 on a $60,000 investment. That is a 100% return on your actual cash. Buffett understands this arithmetic perfectly. He does not dispute it. What he points out is the other side of the same equation. If that same property declines to $240,000, a 20% drop which happened in multiple markets during 2008, your $60,000 down payment is entirely gone. The property is worth less than what you owe. You are underwater. And you still owe the mortgage, the taxes, the insurance, and the maintenance on an asset that is now destroying your net worth every month it sits on the books. Leverage amplifies gains when prices rise, it amplifies losses when prices fall, and it introduces a cost, the mortgage interest, that runs whether the market cooperates or not. The 2008 financial crisis was not a stock market story at its root. It was a leveraged real estate story. Millions of people who believe property always appreciated discovered what happens when leverage runs in the wrong direction on an illiquid asset. An S&P 500 index fund bought with your own capital, no leverage, no debt, cannot put you underwater. It can decline in value. It has declined repeatedly throughout its history, but every decline has recovered, and not a single one required you to keep making monthly payments while you waited for the recovery. You just held. The leverage was never there to destroy you. Leverage is the best argument for real estate. It is also the fastest path to losing everything if the timing is wrong. Secret number 5. Buffett's actual advice for ordinary investors is not to do what he does. It is to do something far simpler. Here is the Buffett truth that gets buried under every stock picking article and every tribute to his genius. He does not recommend that ordinary investors do what he does. He has said explicitly and repeatedly, and in shareholder letters and interviews on record, that the right investment for most people is not individual stocks, not real estate, not any complex strategy. It is a low-cost S&P 500 index fund, bought consistently, held for decades. In his 2013 shareholder letter, Buffett wrote instructions for the trustee managing his wife's inheritance after his death. He did not say, buy Berkshire Hathaway. He did not say buy real estate. He said put 90% of the money in a very low-cost S&P 500 index fund and 10% in short-term government bonds. That is what the greatest investor alive recommended for someone he loves, not his own strategy. The simplest, most accessible, lowest cost strategy available to anyone with any amount of money to invest. The reason this recommendation matters so much is what it implies about real estate. Buffett had every option available. His wife's trust could have purchased commercial property, residential portfolios, farmland, anything. He chose an index fund because over long periods of time, with minimal cost, maximum liquidity, and zero management burden, an index fund outperforms the vast majority of alternatives, including the real estate strategies that require capital, expertise, time, and ongoing management that most ordinary investors simply do not have. Buffett's advice for you is not to think like Buffett, it is to own the index fund he recommended for someone he loves and let it run. Secret number 6. The emotional case for real estate is strong. The financial case is weaker than it looks, and knowing the difference protects your money. I want to be honest about something. The pull toward real estate is not just financial, it is deeply emotional, and those emotions are real and they are understandable. Owning property feels different from owning shares. You can walk through it, you can renovate it, you can hand it to your children. It feels permanent in a way that a number in an investment account does not. And in communities where wealth has historically been tied to land, where property represented stability and security in ways that financial markets never did, the instinct toward real estate runs deep. None of that is wrong. A primary residence that you own and live in builds equity, provides stability, and can absolutely be part of a sound financial life. Buffett owns his home. He bought it in 1958 for $31,500 and still lives there. He has never argued that owning the home you live in is a mistake. What he argues is that treating investment property as the primary or sole vehicle for wealth building at the expense of consistent low-cost equity investing is a choice that costs most ordinary investors money over the long run. The emotional case for real estate is powerful. The financial case, when stripped of leverage assumptions and gross appreciation numbers and recalculated with real costs and real returns, is significantly weaker than the industry presents it. Knowing the difference between what feels like wealth and what produces wealth is the most important financial skill you can develop. Own your home if you can. Build your wealth in the index fund. They are different tools for different purposes. Use both correctly. Secret number 7. The most important thing Buffett knows that most investors do not is the cost of switching. Here's the final truth, and it is the one that brings everything in this video together into a single actionable principle. Every year that your wealth building capital is tied up in a down payment saving in a property that is not yet generating a net positive return, in a mortgage that is consuming cash flow that could be compounding in an index fund, is a year that compounding cannot work for you in the equity market. And compounding years in the equity market are the most valuable years in personal finance. They cannot be purchased later. They can only be used now or lost forever. Buffett calls this opportunity cost. Every choice to invest in one thing is simultaneously a choice not to invest in something else. And the cost of that foregone investment, the returns that did not compound, the base that did not grow, the years that passed without equity market participation, is real even though it never shows up on a bank statement. An investor who spends 5 years saving a $60,000 down payment for a rental property, putting that $1,000 a month into a savings account at 2% instead of into an S&P 500 index fund, arrives at the purchase with her down payment intact. But she also arrives $44,000 poorer than she would have been if that same $1,000 a month had gone into an index fund at 10% for those 5 years. The down payment cost her not just time, but $44,000 in foregone compounding that she will spend the next decade trying to recover through rental income that may or may not materialize at the rate she projected. Buffett's preference for stocks is not a preference against ownership. It is a preference for compounding without interruption, for wealth building that does not require a down payment, a mortgage approval, a property manager, a maintenance fund, a vacancy reserve, or a 90-day exit process. For a vehicle that lets you start with $5, increase the contribution every month, and let decades of uninterrupted compounding build the kind of wealth that takes real estate investors a lifetime of active management to approach. The cost of not being in the market is invisible on every bank statement and devastating on every retirement projection. Buffett never lets that cost accumulate. Neither should you. Stocks or real estate. Now you know what Buffett actually chose and why. 7 secrets, one clear picture underneath all of them. Warren Buffett does not prefer stocks over real estate because he does not understand property. He prefers them because when the full math is on the table, the real returns after costs, the liquidity premium, the leverage risk, the opportunity cost of capital, and the compounding power of equity ownership in growing businesses, the comparison is not as close as the real estate industry presents it. Not for ordinary investors building wealth over decades on a consistent monthly contribution. Real estate has a place. A primary residence builds equity and provides stability. Some investment properties, in the right markets with the right management, generate real net returns. Buffett is not dismissing an entire asset class. He is telling you what he told his wife's trustee, what he has said in shareholder letter after shareholder letter for 60 years. The low-cost S&P 500 index fund, bought consistently, held for decades, is the most powerful wealth-building vehicle available to ordinary investors. And it is available to anyone with any amount of money and any amount of time. Here's your one action for this week. Look at where your long-term wealth-building capital is currently going. If you are saving toward a down payment on an investment property and your index fund contributions have paused or never started, run the opportunity cost number. Calculate what $500 or $1,000 a month in an S&P 500 index fund at 10% would produce over the time horizon of your property plan. Then decide with real numbers in front of you, not with assumptions about what real estate always does. Make the choice Buffett would make: informed, cost aware, and compounding first. Share this with a woman in your life who is putting everything into saving for a property and has not yet opened an investment account. Your friend who believes real estate is the only real wealth. Your coworker who is waiting to invest until after she buys. Your sister who has heard her whole life that property is the safe choice and has never been shown what the index fund would have done instead. Safe is not always what it looks like. Compounding is. And it is available right now, today, with whatever you have. Start there. I will see you in the next video.